My name is Karen Griffith Gryga, and I'm Chief Investment Officer and Managing Partner of Dreamit. As part of the ongoing Dreamit content series, we're pleased to bring to you today the term sheet cheat sheet. And I have two esteemed lawyers with me today to dive into the topic. The purpose really of today is to educate you on term sheet process, term sheet terms, so that you're really educated going into the process. One thing that I will emphasize, and I'm sure that Jeff and Rich, who will introduce themselves momentarily, will agree with me on, as an entrepreneur going into a financing, you need to read every document and you need to understand every term. And part of the role of your lawyers, as well as your advisors, is to educate you on things that you don't understand. So make sure you understand everything. So I'm pleased to introduce the two panelists today. We have Jeff Bodle from Morgan Lewis, and we have Rich Cohen as well. So why don't we allow them to introduce themselves? Go ahead, Rich.
Hi, I'm Rich Cohen. As you said, I'm with Duane, a nice intimate firm of about 650 lawyers. I represent both emerging lawyers all the way up through public companies, so through the entire life cycle. So for emerging companies, it's anywhere from formation to the initial seed financings to the preferred financings through exits and IPOs and such. And in my case, I represent some public companies and disclosure issues as well.
Jeff?
Sure. Jeff Bodle. I'm a startup and M&A lawyer here in Philadelphia. My practice is very similar to Rich's. I represent a lot of emerging businesses from day one all the way to exit, and then the serial entrepreneur has to start another company and does it all over again. Also represent a lot of venture capital funds, a lot of corporate venture capital investors as well.
Great, thanks. And as you heard from both of these guys, every major law firm has an emerging company practice. So with the entrepreneurs, as emerging entrepreneurs, you really want to connect with lawyers that this is their focus. We're going to primarily focus on Series A framework in the discussion today, but occasionally we'll dip into other series as we go throughout the topic. So just to start off the discussion, when entrepreneurs out there fundraising, obviously their goal is to drive to term sheet as quickly as possible. What do you guys have as advice in helping entrepreneurs to drive to a term sheet as quickly as possible?
Maybe I'll take a start and Jeff can chime in. I mean, it seems to be that the term sheet process can really start weeks, months, or years ahead of when you're actually getting the term sheet. To the extent that you're out there and now even at early stages, trying to get to know the VCs so that they understand what your business model is and are essentially able to track you and make sure that you're doing what you say you will be doing over the course of the years is extremely helpful in getting VCs comfortable with you, because at the end of the day, a VC is not going to put out a term sheet until they've done at least enough business due diligence that they're completely comfortable with you. And it really starts, day one when you start meeting these VCs.
Yeah, I would echo that. I mean, I think the most important thing is you need to have a fundable business that multiple investors want to invest in. That's stage one. Then stage two is really building those relationships with the likely investors. You will have to kiss a lot of frogs, but make sure you're kissing the right types of frogs. Don't waste your time with frogs. I mean, you want to qualify investors before you waste a lot of time with them. And then you want to generate interest from multiple investors, because if you have lots of people who are interested, you'll be able to get to that deal faster. If you really only have one or two options in town, then there's really no incentive for the VC to hurry up and invest in you.
Yeah. And for the VCs, a lot of it is, they'll give you some information early on in some of these early discussions. They'll tell you what it is that they're looking for, They might give you some hints about where they see your business model going and such. So it's all free information for you to use as you're building up your business to something that's investable by a venture capitalist.
But also, don't waste your time. If you have a lot of, if you're getting a lot of meetings with VCs, but all of them are telling you similar things that you're not quite ready for a variety of different reasons, take that advice, put your head back down, do what you need to do to get the business ready, and then go back out.
Well, to Rich's point earlier, though, we have a saying at Dreamit and in the VC circles in general. When you go out to raise capital, you get advice. And when you go out to raise advice, you often get capital. So to Rich's point, go out and build relationships early and just say, hey, I'm here for 15, 20-minute meeting. What I want is your advice and feedback. And that's how you start these relationships. So start the relationships early, be in multiple conversations, and be executing on your core business really is the best advice to drive towards a term sheet faster. So I know we're focused on Series A, but often entrepreneurs ask, should I produce a term sheet or will the investors produce a term sheet? What are the proper scenarios for the entrepreneur themselves to produce a term sheet? Are there scenarios?
Well, I'll start with that one. What you have to really kind of crystal ball who the investors in the round are. Clearly, if it's an institutional fund or someone who's really in the business of investing in these sorts of rounds, it's very likely that they're going to want to drive terms. However, if you have a good potential idea of who your individual investors may be, maybe even already having conversations with some of them, and there just doesn't seem to be momentum around the deal to drive towards a term sheet, then what I'd like to do in that circumstance is first to talk to some of those key investors who I think will be the likely targets, try to coalesce with them around some types of terms or structures that they might want to invest on. And then if we get to the point where we think we have something that's workable, then at that point, I think it makes some sense for company counsel to go ahead and assist the company to go ahead and document a term sheet, run it by that first group of initial investors to see if they're on board with it, and then spread it out from there.
Yeah.
So is the entrepreneur driving those conversations, or are you as their law firm involved at that point?
Typically, in my experience, what we would do is prep the entrepreneur for those conversations, whether we want to head down the convertible note or safe route or KISS route, or whether we want to head down the Series C or Series A route, and start to prep kind of what those initial 4 or 5 or 6 key items are going to be that we need to coalesce around. Then we can generate a term sheet from there. But usually behind the scenes, we're walking through a type of term sheet for each of those scenarios and what the key terms are going to be, and helping to educate the entrepreneurs as to what they should focus on.
Yeah, and stage means a lot in determining who is going to be preparing the particular term sheet. If you're talking about earlier seed stages with convertible notes and such, you're typically going to see the company preparing it. If you're in a Series A round with an institutional investor, you're talking about an institutional investor that probably has a term sheet that they are comfortable with, that is informed by hundreds of deals that they have done, so that they're probably going to want to put that in front of you. I think in Series A, the 2 times you might see company-led term sheets are, number one, if you have a strategic investor that isn't doing hundreds of deals. So if you have some industry participant that might lead the A, they might appreciate the help from company counsel. The other time is, as Jeff mentioned, you're going to be prepped, especially on some of the key business terms. So what you often see is perhaps some sort of indication of interest that is put together with the company that's not a full-blown term sheet that's 5 pages long, but maybe a page long with just the key business items, which might be helpful for everyone's thinking, especially if you're negotiating with multiple parties at the same time.
I think the one thing you want to avoid is just sending a term sheet out without a lot of visibility as to what sort of interest and reaction there might be to that term sheet, because then you don't want a scenario where you're sending out lots of different forms of term sheets over time to the same groups of people that you're trying to target, because that doesn't create a good kind of buzz atmosphere around the company and its efforts on the fundraising side.
So what would your advice to an entrepreneur who finds themselves in this scenario where they're trying to coalesce towards a term sheet? What's your advice as to what that first conversation needs to sound like?
Well, sure. So if we're not yet sure on structure, I think the first conversation really needs to focus on, can we agree upon valuation and get to a price preferred round of some sort, or is a convertible note or convertible security the route that we want to go? And that's really understanding who the investors are that we're talking about and what their familiarity may or may not be with these various types of instruments. If you're talking to 4 or 5 real estate investors, you're probably going to go down the preferred route. If on the other hand, you're talking about the types of investors that are on angel list and frequently invest in tech companies, then we're going to be talking about convertible notes or safes or other forms of convertible securities, unless we can agree on valuation and they have a view that they'd rather do a price route. I think that once you kind of pick that choice A or choice B, then there's then the next, if it's a price round, it's valuation, it's liquidation preference, it's board seat, it's protective provisions, those sorts of convertible note, it's cap on valuation, discount, treatment on exit, what happens if no round happens after some period of time. I think if you can kind of start to get buy-in as to where you're headed there, that's when then you can go ahead and develop.
Yeah. And in doing your initial negotiations, you're probably going to have to feel out how serious the person that you're on the other side of the table is with. You might see VCs that have a habit of just throwing out term sheets that are not specific to the company at all, which shows a much lesser level of seriousness than someone you've been talking with, have been really digging into the company and doing their business due diligence ahead of time. Because if that's the case and they really understand the business structure and the numbers, you're much more likely to have a serious conversation about valuation than just numbers that are being thrown out to see if they can lock you up for some period of time.
Right. And that's a really good point, right? The more due diligence that an investor has done prior to term sheet, it doesn't guarantee the money in the bank at the end, but it's more predictive, the more kind of due diligence and more work that they've done.
Right, and that's where qualifying the investor comes into play, kind of knowing and understanding who you're dealing with.
Right.
Yeah. And two things about that. I mean, in a Series A term sheet especially, there's going to be a provision in there likely that the VC is asking for exclusivity for a certain period of time. So once you sign that term sheet, you are locked out of marketing the company to others for 30 to 60 days, which can be problematic if the party wasn't serious in the first place. So you really need to gauge that this is the party you're going to move forward with. And one way to do that is, they'll be doing due diligence on you. Presumably, this is going to be a long-term partner for you. You want to do due diligence on the financing source to make sure that they are the sort of company that when they do enter in negotiations for term sheets, that they follow through on it.
Are there particular positive signs that you guys kind of generally recognize, or are there warning flags that you see in general in these circumstances?
Well, I think it's fair to ask investors what you as the entrepreneur should expect in terms of timing, right? And if you get really fuzzy, wishy-washy answers without, commitments as to, when they can make a decision, I think that's a warning flag, and it's someone who's just kicking the tires, right? I think the challenge you have is if that's the only real interest that you have, then you don't really have any leverage to put pressure on them to come to the table. But if I get lots of fuzzy responses when I'm asking, hey, what are the next steps here? What is it that we need to do to get you comfortable to go ahead and send us over a term sheet, that kind of thing, or start to talk terms, you'll get those fuzzy responses. And I think you'll know at that point that maybe there's not that serious interest here.
Yeah. You really do get a feeling, and you just have to feel it out. I'll tell you, representing VCs as well, you get the feeling on the other side where, you know, the company might disappear for a little while, and it might be apparent that they're not necessarily serious about the investor. So, you know, there's a dance that goes on, and sometimes there are logical explanations for why people are disappearing. I mean, the VC could have a deal closing that day, and the lead just doesn't have that time at that particular moment, you know, or it could be something else, and it's something, you know, you're just going to have to dig at.
Okay, so let's step back a little bit. What advice do you have for entrepreneurs as they think about term sheet negotiations? Is there a framework that you recommend the entrepreneurs to think about? Because ideally, right, this is the start of a long-term relationship. So, you know, what's the best way to kind of think about or approach term sheet negotiations with the framework of this is ideally going to be a long-term partner with me?
I think, Karen, you raised a great point. And one, the deal is not yet closed either. So the VCs are evaluating you even in connection with the term sheet negotiation process. I'm a personal believer in, you know, don't try to be too greedy here. Let's try and build a relationship that's fair for both sides and figure out what both parties' objectives are and how we can bridge any gaps between those objectives. So I think you want to really do your homework first so that you understand what are the types of things that are going to get negotiated, figure out what you care about, what you don't care about, and where your gives and takes are going to be, and then have an honest dialogue, business person to business person, about those points. And then after that, on the key points, then, you know, the lawyers can send back the revised draft. I think that's the best way to do it. It shows the VC that you're serious about the terms, that you understand what the issues are, and you understand what you care about and what you don't care about.
Yeah, and I think this is an interesting aspect. The interesting thing to think about is the relationship between you and your lawyer and the other side and their lawyer. In negotiating the term sheet, it's probably pretty early on for the lawyer to be, you know, handling the whole thing, so to speak, which you might see more when you're negotiating definitive documents. So in the case of a term sheet, it's probably a better approach if the entrepreneur is extremely well educated in what the terms of that you're going to see in these sorts of term sheets are. The lawyer is there as a sounding board for you to make sure that you know what's market, what's not market, and such. But this is a situation where the entrepreneur can really take a lead, especially in negotiating the business points and the valuation and such. And when you think about it, this is going to be your first interaction, probably from a business sense, with someone who, if they sign a deal with you, is going to be on your board. And, you know, you might have to handle some tough issues with them down the line. So how they're negotiating against you and how reasonable they are and how reasonable you are is probably reflective of how things are going to be down the line. So you need to make sure you're comfortable with the other firm's style and culture and willingness to help.
So are there, you know, to this end, are there typical terms that an entrepreneur should understand is most important to the VC? And are there particular terms that, you know, they should understand that are most relevant to them, right? Because the way I, you know, and I know you guys do the same thing, coach them, and the multiple terms are the different tools in the tool belt, and there's give and take among them, as Jeff said earlier. So are there kind of a subset of terms that people need to focus on and truly understand deeply?
Yeah, I mean, maybe I'll start with that. I mean, you know, obviously valuation, right? That's first and foremost, because that's the percentage of the company that you're going to have at the end of the day. And you want to make sure that that's fair to you, it's fair to the person making the investment. And we'll probably talk a little bit about options and how that plays into valuation a little bit later. The other key terms that you're always going to talk about are liquidation, and we can talk about some some trends with respect to liquidation, but you really have to understand what liquidation preferences are and what the options are, as well as dividends sort of go hand in hand with that. And there have been some changes in the markets I'm sure we'll talk about a little bit later with respect to some of those terms. A lot of the protective provisions are pretty basic. So you're basically going to see more or less the companies or the VCs will have similar terms of protective provisions they want. I mean, the key is you're probably going to be handcuffed for doing fundamental actions like raising future money and sales and stuff without VC approval. And then you're always going to talk about the board and how that's going to be structured.
I mean, I would echo Rich's comments. I think there's really two types of provisions in the term sheet that you need to focus on. Provisions that touch upon economics, and I would include valuation, or converting into the round, what sort of dividends do we have, things like that all touch upon economics. And then control, which is really the board composition, the protective provisions, the vesting provisions related to the founders, the drag along provision, things like that. You really can lump them in those two buckets. And I think you have to understand who you're dealing with. Are you dealing with a West Coast investor in a hot deal with a serial successful entrepreneur who has a lot of leverage? Are you dealing with maybe another type of East Coast fund who likes to control the strings a little more tightly? I think that's an area where talking to your lawyer about what this particular investor is going to like or not like, and where you think their hot buttons may or may not be, is important. But some of that's going to depend on the type of investment.
So what are some of the in-market terms today as it relates to, liquidation preferences and dividends and so forth? Rich, you started to touch base on those.
Yeah, so with respect to liquidation preferences, and just to take a second to explain maybe what those are. So in connection with a change of control transaction, there's a question of how the money will come out. So typically there's some sort of preference where the investor is going to get their money back, maybe plus some preference, which is essentially the equivalent of interest on a note, right? And then the question is, after they get that preference back, should they get an additional preference before money goes to the common stockholders? And then another question is, do they participate with the common stockholders? So essentially, the investor gets their money back plus whatever the preference is, and then the pool of money that's left over after that, do the preferred holders split that with the common stockholders on a fully diluted basis or on some basis, or some mix of all of that? I think the current trend is essentially to say, look, the VC will either get a preference back, so they'll get their money back plus maybe some preference if there is one, or they'll have the right to convert into common stock, but they won't essentially double dip by taking the preference and then participate with the common. So I think that's different from the way it was 5 or 10 years ago. And, certainly a West Coast thing. It's been seeping this way, I think, pretty much everywhere. Jeff, has that been your experience?
Yes, I would say, kind of the increase in activity in the New York market has helped to bring some of the West Coast, and just transparency through the internet has brought a lot of the West Coast more founder-friendly terms to the East Coast market, although every deal is different. And I think there are still some angel groups and some funds who are more focused on cumulative and maybe the investor gets their evaluation, wants to claw it back a little bit through the use of some other provisions. And some of it just depends on the quality of the entrepreneur and the quality of the opportunity. Again, if you've made money for investors before and this is not your first rodeo, I think you're going to get a little bit more breathing room from investors. Or if it's that you've done a really good job in generating a lot of interest from different types of investors, such that you really have a competitive deal, you're going to have more flexibility to be able to negotiate these terms.
Are you in a Series A that the investors are controlling the board? What's the trend line there?
I mean, I think there's a mix. I mean, I think most people will take the position, or at least I personally think it's the more reasonable position, that the board control, or the makeup of the board, should be at least somewhat commensurate to what the ownership of the company is. So if you take the preferred stock and you essentially pretend that it's all converted into common stock, if the VC owner has 20% of the company, and typical is a 5-member board or something like that, you would think that the preferred stockholder should have 1 board member. That seems to be the fair thing to do, and I think that that's where the market is trending on that issue. What you will find is particularly aggressive VCs or such will just say, no. The way it should work is you should have 1 representative of each class. So you have a Series A, 1 Series A, or 2 Series A, and then a same number for the common stock, and then maybe you top it off with an independent director. If you think someone is pushing that way, then the independent director becomes excruciatingly important in this discussion. So, one strategy is to have an independent director on your board sooner rather than later, before you even start these negotiations. Obviously someone who a VC would think is a value add to the company, but at least maybe, quote unquote, they're on the common stockholder side, is one thought. Because if not, if you're naming that independent director later on in the middle of the negotiations, you might see the VC coming up with, people they've worked with in the past who, either may or may not be truly independent or beholden to the VC.
So what I would say is a lot of it depends on the size of the Series A round and the faith of the Series A investors in the founder who controls the board. If you have a lower, say a 10 to 20% Series A, then you're not going to have an independent board, I would think, in that scenario. I think you're probably still going to have a founder controlled board with composition by the A and protective provisions that help give the Series A some negative degree of control. I think if you're more at the 30-40% end, then you're going to be in a scenario where an independent board really starts to come into play. And I would agree with Rich, kind of how you designate who that independent director is really is a significant negotiation, because there's a lot of different ways to do it from a contractual standpoint, and then there's also the practical standpoint, is who is that person going to be and how are you going to find them.
Yeah, and one other thing, which is going to one of Jeff's points, and when I'm trying to message this to an entrepreneur about how they should approach this with the VC, one thing you can always say to the VC is, look, you've negotiated for all these protective provisions, which are essentially the negative rights that you won't do certain things without getting the VC's approval. So if you have that, maybe taking more control of the board, which might make you a bit uncomfortable, is not the way to go. And that's the way a lot of times that negotiation goes, because obviously the board has some power going forward in trying to structure whether it's future deals or employment relationships and such. So it is an important thing for the entrepreneur to have a handle on.
Yeah, so I do have a number of questions coming in, but there's 2 questions I want to address, and then I'll address some of these questions that are coming in. To the effect that you guys, talked about protective provisions in the board, entrepreneurs need to pay attention to the percentage, right? Whether it's a straight majority vote or a super majority. So make sure that you're doing your math, right? when you're figuring out the terms of your deal. What are you guys seeing in terms of redemption clauses? Is there a trend line there?
Again, this has historically been an area where maybe East Coast practice and other practices differ. I think some of it depends upon, again, the type of business and the founders involved. If you're clearly a business that is focused on driving towards a successful exit, I think you can be reasonably confident that you can convince most investors not to have redemption provisions. I think that the historical concern driving those provisions was really concerned by the investors that, hey, we could turn this in, the founders could turn this into a lifestyle business and it could generate cash, but we're not really driving this towards a successful exit, and I don't have a way to get value on my investment. On the other side of the coin is, of all the provisions that we talk about, redemption is one of the ones that I'm the least worried about, because if you have a 7-year horizon or even a 5 or 6, the reality is if the business is not saleable, those redemption provisions aren't really worth anything in any event. So I think as a founder, I'd be much more focused if I really had a recalcitrant investor who insisted on that, on the other provisions. That would give me a lot more comfort, because a lot's going to change between now and 5 or 7 years from now. The only thing you have to consider, though, is in any of these rounds, you are laying the foundation. And it's something that I counsel investors on as well, that whatever rights are in this deal, in this Series A deal, there's a good chance they're not going to get any better in follow-on deals. So something that you agree upon now may come back to bite you later when the size of the round increases and those future investors take advantage of the provisions that were negotiated in the initial round.
Yeah, and one thing we see also is a bit of a compromise on the redemption issue. So a redemption could really just be a put that says 5, 6, 7 years later, the investor has the right to essentially, put the stock to the company, which could put them in a liquidity situation. What I've seen some VCs do lately, because they think it's a softer term, and I don't know if I necessarily agree with that, but they essentially, instead of having a redemption right, have a right for the VC to, together with the company, pick an investment banker to put the company up for sale at that point, because it's time for the VC to get out. So at that point, everyone will get out at a fair price.
And that's a good point, Rich. I mean, the drag along can also come into play, right? Some investors will insist that they control the right to sell, even if they don't control the board generally. Other times it's a mix of composition. So you want to pay attention to the drag along provision, because that's essentially your forced provision.
Okay. So what's your advice in a scenario where an entrepreneurial team has gotten a term sheet, they really like the lead investor, but they've gotten like some way out of market terms? What advice do you have for that entrepreneurial team?
Do they like the VC in this scenario?
Yes.
I mean, it's a negotiation like anything else. I mean, you're going to have to do a deal that you are, as Jeff said, literally have to live with for the short term and potentially for the long term. The one good thing about it is that if they are really out of market and you go to your next deal, you might see the next VC laugh at it and potentially change the deal around. Where you see that more is sometimes the terms that you see in convertible note deals can get a bit wacky because you're dealing with smaller investors who have specific needs, or some of the angel groups especially can get particularly aggressive. I mean, we've seen situations where, because of essentially the equivalent of down rounds in convertible notes as the caps change between rounds of convertible notes, if you would have done the math, the common stockholders would have been left with nothing, and you would have had to issue more than 100% of the stock, which is obviously a mathematical impossibility. So the VCs will just laugh and make everyone renegotiate the deal. But no, if they're the right VC, you might have to swallow some things that you don't like, but it's a negotiation again. This is where the lawyers might be helpful, to have a heart-to-heart, lawyer-to-lawyer, to say, come on, what's the reason for this?
But I would always go with the right partner over the best terms. So if that's the choice, but I definitely think it is important to flesh out with that investor why those terms are in there, and what they reveal to you will help you to understand whether that investor is the right partner. It may be, I've seen some weird terms come into term sheets because investors have gotten burned in certain ways by entrepreneurs over the years. And so they vow that they're never going to get burned under this scenario again. So they put something funky in to deal with that. Or it may be that they haven't been paying much attention. They used a random term sheet that maybe didn't quite fit the bill for this situation. So they just need to give it some more attention because they were in a hurry to get a term sheet out to satisfy the entrepreneur. There could be lots of different reasons for different provisions, and just the fact of having those conversations on how each of those situations are going to be handled will help you to build the relationship with that investor and either confirm or refute your initial inclination as to whether that's the right partner.
Yeah, you see that a lot as you're negotiating documents as well. The term that they put in the term sheet might have been normal, but then they're adding some quirk to it to protect something that has happened to them in a past life. And often there's not much you can do about it.
Okay. So I've gotten a number of questions regarding the, what is the right amount of capital to raise, right? So this is kind of more of a business term than a legal term, but, one of the questions was, recently I've seen a lot of press and content focused on not raising as much money as you can and not pushing for the highest valuation possible, both of which may put pressure on the company to pursue risky growth. Any thoughts on those themes and why an increase in the prevalence of this thinking?
I think that was the storyline of Silicon Valley last season. So essentially what I would say is, getting the highest valuation isn't the be all and end all, because the only way you make money and the only way the VCs make a significant amount of money is if the company ends up being a home run. And that means that there's going to be more than enough money to share at the end of the day. A touchier issue is making sure you're raising the right amount of money, because, running out of money is problematic when you're negotiating the next round and you then become somewhat desperate and, sort of blood in the water. VCs might be able to sense that, and you could end up with either not as high a valuation next time around, or a down round, and then all the anti-dilution provisions kick in and such. So you need to make sure you have, sufficient runway, I guess not a ridiculous amount of runway, because the less money you raise, the less dilution, and the more the next valuation kicking in a higher round will help you. So it's a mix. You really need to do the financial modeling to make sure that you have runway plus a little bit, because again, negotiating rounds, your first round, second round, third round, is always going to take longer than you think. It's just a fact. And we can give you timeframes of how long it takes, but finding the right partner is the hard part, and it takes time.
Yeah, I would echo those comments. I think my personal bias is, particularly as it relates to the Series A, if I'm comfortable with the valuation, I would raise more rather than less, just because I'm not sure when I'm next going to get the bite at the well. And some of that's going to be driven by business performance, and it may be that things take longer time. So on balance, I would probably take in a little more. I think the issue is really more relevant in the Series B. Each time you're at an intersection, when you raise a lot of money, it means that whoever you're raising that money from is going to have expectations on the size of exit. And you have to make sure that there's pretty transparent discussion as to what the exit scenarios would look like, and timing and things like that, and how much you raise will impact that. I wouldn't be too greedy on valuation. I think it's more about finding the right partner, finding a valuation that kind of works for both sides and has a little bit of give and take in it. And by the way, the two are related, right? It may be that you're comfortable taking in more money if you can squeeze the valuation up a little bit so that there's not too much dilution. So, that's why I think when you want to be careful when you go out there, not necessarily just saying, hey, my valuation is X, because I think it's really going to depend on how much you're raising. And some investors are more focused on what percentage interest that they own at the end of the day, but they're willing to put in a little bit more money to work to get to that percentage.
Yeah, as these guys have said, it's a combination of how much capital you're raising, the valuation, the metrics and milestones you need to to achieve with both that valuation and capital raise, within a set time frame. So where companies get in trouble is really if the valuation is too aggressive, then the metrics and milestones that they need to achieve in order to raise the next round of capital are kind of beyond what their the amount of cash that they raise can get them to. So it's really a fine balance between the amount of capital you raise, and yes, you want cushion because it always takes longer and costs more, always. So the amount you raise, the valuation, your metrics and milestones all kind of interrelate and play together. And you really want to talk to your lawyers, your advisors, people with domain expertise to really get guided on those metrics. And the important thing to realize is that investors approach an investment from a risk-reward profile. And the higher your initial valuation, the higher the risk profile of the company. The lower the amount of capital you raise, the higher the risk profile. So it all kind of, it's like a puzzle that fits together that you really need to kind of think through carefully and plan for. Another question that I've gotten, it's kind of complicated. Have you seen circumstances where the returns to the investors are somehow capped, and then there's kind of a change in terms? Have you seen this at all? I mean, obviously we've seen liquidation preferences that, max out at a cap, but I've never seen something that caps a return profile. Have you guys?
I mean, I've done deals where there's, it goes to the liquidation preference. So instead of just a 1x return, there's essentially, it can switch back and forth, so to speak, even between different classes. It happens a lot when there's different classes of stock, even preferred stock. So, the latest round might get a certain out, and then it goes back to the old investors and might switch back and forth. Capped to a certain amount so that they don't end up getting that greedy. But what is often the case is that if everyone decides to convert, it all gets thrown out the window and everyone will just participate based upon their percentage if it's better for everyone. But you do see, I have seen those sorts of variations where there's an additional preference so that it's not fully participating essentially, it's partially participating because you're getting a greater preferred is how I would describe it.
Yeah, so what I would say is generally in later stage deals, I would agree with Rich. You can have a variety of what I will call engineered waterfalls designed to address different outcomes and whack up the value received across the classes based upon those different situations. In an early stage deal, I would say it would be very unusual to see that sort of feature. The only feature that I would sometimes see would be adjustment provisions tied to certain milestones being reached, but that generally tends to go the other way, that if you don't hit the milestone, then the investors get a greater share. But you could do it either way. But I would say it's unusual very unusual for an early stage.
For early stage VC, it's very unusual, right? Because the reason why investors are investing is for the upside.
That's right. Your VCs are not a bank. They're
right.
Not in it for simple interest. They're in it for risk capital and a high reward on their investment.
But you guys mentioned the waterfall, and there might be this might be terms that some of the entrepreneurs aren't familiar with. But the waterfall is basically when the liquidation preference portion of your terms is triggered. The waterfall is basically what series or common gets what, when, and how. So it's a combination of your terms, your cap table, and kind of the waterfall of the cash flow should the liquidation preference or the liquidation preference terms get triggered. So that can be, in later stage companies, very complicated. But again, it's something that if you find yourself as an entrepreneur in a waterfall situation, you want to make sure that you really understand that flow of cash flow.
Right, and I think the key thing to understand there is really that it's not just about what your percentage interest is of the company. It's really in an exit transaction scenario, what are your proceeds going to be? And that may vary not just based on your percentage interest, but also based on liquidation preference, dividends, and other provisions.
Right. So what are there kind of major pitfalls that you guys see in both an angel or seed round and then a Series A round that you want to warn the entrepreneurs out there about?
I mean, I'll say one thing, which is you should constantly have some sort of spreadsheet where you are monitoring the impact of the money you're raising at an early stage and essentially modeling it how your cap table might look in after a Series A financing. So, you know, when you're raising convertible notes, depending on the amount of the money and the discount and such, and the amount of money you're going to raise in a Series A, it could significantly impact the percentage that the founders have once you get to a Series A. And of course, the purpose of doing a convertible note round is that you don't value it, so that therefore you don't know the specific percentage that those note holders are going to end up with the company. But if you're not monitoring it, you could pretty quickly end up with a percentage of the company that you're not comfortable with, which means that either your valuation in a Series A has to be really high or something like that for it to be, you know, for it to correct itself. So again, I don't think entrepreneurs are always, you know, they just said, oh, it's great, I got $800,000 in convertible note and I'll deal with it later. You should have something on the side where you're monitoring what the current situation is.
I would agree. It's got to fit within the plan of what your Series A is going to be. And, you know, the short answer there is don't hand out convertible notes like they're candy, right? I think if you do that, you'll be all right. I would say you want to be prepared for the process. You don't want to have just this company that's a total mess. And so, you know, the term sheet comes in and then the investor goes, oh no, and everything slows down because their lawyer has to work with your lawyer to clean everything up. So you want to have good hygiene as you go. And I think the biggest thing is, we've already talked about it already, but make sure that use the term sheet negotiation as a way to align expectations between the parties on what the key issues and trajectory and milestones are going to be for the company, and build the relationship with the VC so that, you know, in the inevitable pitfalls and highs and lows of the business later on, you can draw upon that relationship so that both sides get to the right place in that scenario.
So what do you mean by good hygiene? And could you also kind of bring in common mistakes that you see with cap tables, you know, as part of kind of your good hygiene comment?
Sure. So, I mean, good hygiene is simple, right? If we brush our teeth every day, we'll make cavities, right? So, from day one is the time to pay attention to this stuff, because your business is only going to get more and more complicated after day one. So, and the good news is technology is easy. Every signed contract, make sure that it's both parties have signed it. The full copy of the contract in signed form is in your Dropbox folder, whatever your online repository. Make sure that anybody who touches the IP assigns the IP over to the company, and that it's clear. Just saying that I'll keep the information confidential is not enough. They need to assign the IP over to the company. In terms of the cap table, don't make promises of percentage interest. You know, there are clear regiments under Delaware law for what is required to issue stock or options. And generally, the way you're going to do it is have a board consent that approves with detail the issuance. You're going to need to think through valuation issues and 409A issues. So you may want a valuation or have a board consider the 409A factors. You're going to have a piece of paper that documents what the terms of the equity issuance are. But most importantly, you know, if there's vesting, which there almost always will be or should be, that has the applicable vesting provisions in that agreement. and you're going to keep copies of that signed agreement. You're going to make sure that if a founder's getting restricted stock, they file the 83B with the IRS. So it's a matter of just keeping track of these papers and keeping up with it on a day-to-day basis, because it's only going to get more complicated. And capitalization, the biggest thing is just don't make. I mean, I saw a scenario. We had a client where a founder, a former founder, had a draft complaint where the exhibit was, hundreds and hundreds of text messages promising different types and forms and percentages of equity. And that's a mess. And that basically is going to result in having to pay off that former founder to clean that up. And there's lots of instances where people are not careful in how they describe what the equity arrangement is going to be and when it is going to be official. And so we want to try and avoid that.
Yeah, and all of this stuff is going to come up as you're negotiating the term sheet or just after it, when the VC and their lawyers are going to ask for a due diligence package. They're essentially going to ask you for all of these documents to be produced. And if they can't be produced, then it may or may not raise questions in the minds of the VCs about the competency of the management team. And I can't believe I would say this, potentially their counsel, if all these things aren't in order and things haven't been approved and such. So it's important. It's just one more box that they can check that shows you're competent in running a business.
And it'll get the deal done quicker.
Yeah, I agree with those comments 100%. One of the questions that entrepreneurs often ask is, why a 3 or a 5 year, business plan? And, the fact of that is that the VC is looking for insights into how you think about your business. The same thing is true here. If you're organized with your due diligence and your legal documents, that's a sign of good execution. If you're a mess, and even if you have a term sheet, you're likely to blow up that term sheet. And in this day and age today, there's no reason not to be organized, right? There's cap table management cloud solutions like eShares that also offer 409A, valuations inexpensively. There's Dropbox where you're just putting your documents as you get them. That, good legal hygiene is important from day one. So let's step back. I have 2 questions I want to get to. One is option pools, right? How should entrepreneurs, as they're going into their series, think about their option pool? And, are you seeing trends in terms where the option pool is part of the pre-money or post-money?
I mean, there's a huge difference if the option pool goes in pre-money or post-money. The bottom line is, if you put the option pool in pre-money, so you determine how many shares you want to have available to issue to employees after the deal. But if they're all in the pre-money valuation, it essentially devalues the company because those shares are only diluting the existing investors. If it's put in the post-money, then it dilutes both the existing investors plus the VC or the institutional investors, the Series A investors, after the deal is done. Now, again, if you're looking at it from an equitable standpoint, I think what a lot of people would argue is that it's more appropriate to be post-money because the contribution that the employees that you are going to give those options to are going to benefit both the investors who exist today and the Series A investors. That the investors would probably, number one, argue otherwise. And by the way, it's a great way for them to give you a higher valuation. But because you have sort of these phantom equity shares, really the true equity in the hands of the founders is at a lesser valuation, so to speak.
I think the majority of the time it's going to be in the pre-money if you're dealing with a fund, an institutional fund as the investor. And I think as a founder, that's fine, because as long as you understand that going into it and take it into account when you're negotiating valuation, so that you understand the impact that it's going to have on the cap table and your percentage interest, then we can figure out the right place to be. I think where it's more problematic is, the entrepreneur will come to me, he or she have already agreed with the investor on valuation, and then we have the term sheet, and then we see all these other things that could impact the slice of the pie of the founders, and we've already kind of crossed the valuation ground. So it just depends on, you want to understand all of the issues that impact economics.
Yeah, and a lot
to partner up with as investors. But in my experience, sorry. Go ahead.
No, all I'll say is a lot of times in these term sheets, you will actually see a capitalization table attached to the term sheet along with what the per share price is in the offering. And the reason for that is it's so you can go into these deals with your eyes wide open as to how the options are going to impact the valuation to make sure that you understand. And again, I think we both believe that the valuation isn't necessarily the end all be all, but you want to understand what it is you're signing up for.
Yeah, and then in terms of the size of the pool, I think you have to be realistic and have a conversation with the investor as to really what the future equity needs of the company are in terms of hires. For example, do the founders represent the management team that's really going to take this entity forward till the next round of financing, or do we need some critical supplements to the team? If it's the latter, then the pool is going to need to be larger than if, essentially the core team is already in place. So that's a practical way that you can have a concrete discussion with the investors as to what the size of the pool should be. Although, of course, looming in the background is what is the impact on percentage ownership?
Or another, did the founders give too much stock away essentially in the early round such that they're not properly incentivized with the amount of common that they'll have after the Series A investment is needed, and therefore need to be incentivized by other means, which again is a often uncomfortable conversation to have.
Yep. Okay, I want to discuss two more things. One is side letters, and one is just advice to entrepreneurs in general regarding legal counsel in the early stage. So if the audience out there has other questions that they really want addressed, please send them in. So what about side letters? Do they affect the dynamics of the round? Or are there pitfalls with side letters?
So just as background, so a side letter are essentially certain investors potentially asking for special terms that you're not necessarily making available to everyone in the deal.
Mm-hmm.
Often it could be helpful, right? If the term is, we have LPs and they like to also invest side by side, so giving them the right to some sort of future investment. I mean, that might be a positive to the company because it automatically increases the pool of investors for the next round who seem to be very interested in it, or at least the pool of people you can go show. So there are situations where I guess what I'm saying is it's fact dependent, right, upon what it is that's in the side letter and what they're asking for. But you have to be a little bit careful because you don't want to have disparate deals among investors in the same deal. So it has to be something that clearly makes sense and you can defend because you don't want other investors getting pissed at you.
Yeah, you have to be cognizant of, do you need to disclose those terms to other investors? If you do, are they going to want the same terms? Why is it that you're distinguishing? Sometimes it can be stuff that's not really driven by economics, but something that particular investor needs given the nature of that investor and its investors. It might be some regulatory provision or some special rights related to things that they need. But if it's economics, I think you need to think through what the justification is. And two, you got to make sure that you understand how those special rights might sunset over time as well. A lot of mistakes I see entrepreneurs make is they have side letters that are essentially evergreen and go on forever, and they issue them with lots of different parties, and then it's tough to clean that up later on.
Okay. So the next question is, Duane Morris, Morgan Lewis, both, established large legal firms that Dreamit's done extensive work with both you guys, and you both do great work. What's your advice to entrepreneurs, either pre-seed or pre-Series A, about their legal counsel? What's the typical structure in which legal counsel works with early stage companies, which are usually in a cash constrained format? What happens if you bring in new counsel prior to closing a round? Just kind of lay the landscape out for entrepreneurs that might not have, a formal lawyer yet at this point.
And maybe I'll start and then Jeff can chime in. But yeah, number one is it's excruciatingly important to work with a lawyer who works with emerging businesses. I mean, first of all, at the end of the day, it's going to be cheaper for you because they're going to have documentation that early stage companies use regularly. And the one thing I've learned is, it's relatively expensive, presumably, to do something right, but way more expensive to fix something that was done wrong. I mean, we love clients that do things wrong because then they come to us. In terms of emerging business lawyers generally, I mean, the play for us is to watch companies like you guys grow, because it's once you get financing and have big boy, big girl issues that, real legal work occurs. I mean, employment issues, you might end up with some sort of litigation, things like that. So the idea is we, more than anyone, want to make sure that the companies get funding and then, end up with more complex legal issues. So I think one of my IP lawyer partners had a great example, which is, you have the goose that laid the golden egg, and for a lawyer, you can either eat the goose and charge them a lot of legal fees up front, or, eat golden eggs going on. And that's why I think a lot of firms like ours and Morgan Lewis have different arrangements that can be put in place to make it less painful and more reflective of how the cash flow works with these sorts of companies to match it up.
Yeah, I would agree with everything Rich said. I think it's, in terms of how the structures work, it's typically a combination of deferring fees until that event where the company has money, but more importantly, the fact that we've kind of been there, done that, so that we're incentivized to let the company spend its precious dollars on hiring more developers, figuring out how it can succeed as a business and grow and have more sophisticated legal needs. So it's really in both parties' interest to keep the spend low, particularly in the early stages. So that's generally how the structures work. And what we try to do is, so there's no surprises, we have conversations with the entrepreneur and say, hey, this type of thing is going to cost this much. This is going to cost that much. Some of what we do is say, hey, you might want to keep this a little more simple, because if you have some cockamamie convoluted arrangement because you really don't have a meeting of the business mind, then that's when the legal fees go up to deal with a scenario like that, where it's some convoluted relationship. I think it's important, if you are in a regulated business or if you have a business that has some sophisticated legal challenges, that you talk with a lawyer sooner rather than later to start to get your arms around that. It's not that you're going to necessarily spend a lot of money digging to the bottom of those issues from day one, but then you can at least get some education on what those issues may be and start to plan out over time. Hey, I may need to do some research in these 10 states that I'm rolling things out on in some new novel gray area. And so as part of my Series A, I may need some budget for that. How much is that going to cost? And then you can plan for it in terms of the size of raise that you're looking for.
Yeah, and I'll say in my experience, because Jeff mentioned the fact that a lot of times we'll try and give you a range of what it is, because clients don't like it when it comes in thousands of dollars more expensive, because evidently there are other lawyers out there. And the one thing that I will say that always puts it at the high end of the range is that if you can just negotiate whatever the business deal is, whether it's a contract or a seed offering or a Series A, and give us the terms and we can just document it, then we can make whatever few changes are necessary. But if you are constantly changing the deal, that means that we are constantly changing the documents and the clock is running each time you're doing it. And you know, whether you're paying up front or deferring it, at some point that bill is going to become due. So you want it to be the most efficient possible. And the other thing I'll say is, you know, in looking for a lawyer, you want someone who's going to be responsive and educate you. I mean, that's certainly the style of our firm and people like Jeff. And that's crucially important to have people that you can actually talk to.
Yeah, it's no different than, you know, finding the right partners at VC. You're going to hopefully have a long-term relationship with each other over potentially multiple businesses over your lifetime. So it's got to be someone that you like spending time with, that you trust, and there's got to be that collegial, collaborative relationship.
Yeah. So, you know, one of the things that I tell my entrepreneurs is, you know, there's 3 elements to investors. There's capital, there's domain expertise, and then there's startup expertise. And the holy grail of an investor is one that has all 3: domain expertise, capital, and startup expertise. In the case of legal representation, you know, and sometimes in funding, you just need to accept the capital, right? In legal representation, you ideally want this, you need the startup expertise. It's helpful if there's domain expertise, but it's never just about, oh, they're a lawyer, they'll help me with legal work. Because as Rich said, that's when, as an entrepreneur, you know, a lawyer is not a lawyer is not a lawyer, meaning there is expertise around emerging growth companies. And the more kind of standard you are in your documentation, the better it is for the long term. And as Rich said earlier, when companies mess with that early on, then the legal fees really pile up later on to clean things up. So I thank both you guys for your time. I think this has been a really helpful discussion. Any last minute words of advice that you have for the entrepreneurs out there?
Just keep executing. Like, don't this, you can become overwhelmed by all this stuff. I mean, if you build a really good business, you will generate interest from investors, and this stuff will work itself out. But just keep driving forward. Don't use, you know, the complexities of understanding all the nuances of term sheets to, you know, freeze in place and not move forward. That's one of the biggest mistakes that I see entrepreneurs make, is they just get overwhelmed by this, and they just kind of shut down, and as a result of that, the business just suffers and stays in place.
Yeah, and I think along those lines, essentially the fundraising starts now and will be continuous, because all these contacts that you have, whether they're with VCs or people in the industry, potential strategic partners, you know, they're all potential initial discussions in connection with the future financing. So listen and execute, and hopefully you'll end up with some money in your company's pockets.
So I want to thank you. I'm Karen Griffith Gryga, Chief Investment Officer for Dreamit, and I want to thank Jeff Bodle of Morgan Lewis and Rich Cohen of Duane Morris for sharing their time and expertise with us today. Thank you, everyone.
Take care.